John, so many questions, so little time. Let's start with the chart, because often it best sums up the mood. This is emerging market assets. The white line is the MSCI Emerging Markets Currency Index, which, since Trump's victory, is down by 3%. The blue line is the Stocks Index, which is down by 7%. And the purple line is a local EM sovereign bond index, which is down roughly 2 or 3%. How much more of this emerging markets sell-off have we got to come?
So it could have a decent leg further to go, because there's really two drivers behind this. I think it's getting partly caught up in the Trump slump, as you called it. It's good you've got Trump bump and all sorts we can have in the next 4 years, haven't we? But you've also got the slowdown in China. So the credit data there has slowed down, and that tends to precede a slowdown in economic activity. And so while the October economic activity did hold up, there's an expectation from us and from others that that will now slow over the next few months. And as it does, it could really reinforce the effect of Donald Trump. So,
I mean, I hate to put numbers on it, but, you know, 7% decline in equities, another 5%. I mean, you know, currencies, as I said, 3%. I mean, where does it end? What sort of final decline figures are we going to be looking at?
Absolutely. If we get an enactment of a China slowdown and that refocuses markets on it, you could easily see the outperformance of emerging markets over the year wiped out, which would be about another 5%. And it could go further, of course, if the latest China concerns turned out to be worse than the last leg in January and February of this year. And of course, every time they do this, it does get a bit harder, because they have to put so much credit growth behind getting the economic growth that they're targeting.
But, you know, John, one of the interesting things I think about this is how much currencies have weakened, from the euro to emerging market currencies to the yuan. Surely central bankers are secretly a little bit pleased, including the Bank of Japan governor, that, you know, their currencies are weakening.
Absolutely. So this is a godsend for Abe. He's been able to completely maintain yields where he wants them in Japan, and they've been the standout performer in terms of remaining where he wants them. So it's some evidence that his yield targeting approach can really work. So for him, it's great. But others, it works less well, of course. So in particular, it's been mentioned, but in Europe, you have Italy and the spread widening coming at a bad time for them and for their Prime Minister Renzi. And then, of course, we have the emerging markets, where the increase in US interest rates pushes up their costs of funding.
So where might we see problems? I mean, clearly we have our eye on Mexico, and we have had our eye on Venezuela and Brazil for other reasons. But in terms of just the direct impact of higher US rates, where might we see some big fallout?
So it will tend to be the fragile 5 again, or that kind of area, so where effectively they have quite high needs for financing, and effectively as rates rise, it starts to pick up. So it should be across developed market, emerging markets, sorry. But in particular, you have to be quite careful about this interaction with the potential China slowdown. And the reason for that being that on the oil side, a lot of emerging markets have benefited from a combination of low but relatively predictable oil prices in some way, moving within a range. But considering that we have the upcoming OPEC meeting, which has a chance of significantly pushing up oil prices, then it is really worrying how much they've slipped since the announcement in September. We're now sat back at oil prices that are back at mid-August levels, and that's against this potential upside risk that we could head up to $55 or $60 if we got a positive surprise from OPEC in terms of how much they cut. So what does that tell you about the real fundamentals? And the reality is China's been a huge marginal buyer in this market, both this year and last year. In some ways, China has been the saviour of the global oil market. And the reality is, if they step away into year-end, it will be heavily felt by the balance of supply and demand. And in reality, I think on a fundamental basis, we're looking at more like $40 a barrel currently. So it's probably $3, $4, $5 below where we see it on the screens because of this upside risk. And I think if we were down below 40, it would already be a main focus for the markets. I think that in a way we're missing some of it because of this upcoming OPEC meeting.